Well, thanks everybody for coming. We have a good group, a small group, but it's a quality group, so glad you're here. Before we go too much further, I do want to recognize BJ, who lets us use this beautiful facility for free. So would you like to stand up and tell them a little bit about you and the kind of services that you offer?
Yeah, so BJ Browning. So I'm actually part of the real estate response team here at Master Services. So basically, when a house is on the market with an issue on the home inspection report pertaining to crawl space repair, basement waterproofing, foundation repair, or also concrete lifting or leveling, we come out there and address those concerns and help get them to the budget table. So,
Awesome.
Yeah.
So great partner for us and a potential real estate investor. So that's the way you grow and you learn as you attend these events and you listen, and then you have a knowledge base that you can build on.
Thank you.
Yeah. Thank you for coming, everybody. I'm glad you came out. It's getting dark outside already, so I know it's getting harder, so thanks for being here. So Brenda and Cindy Hewitt do not provide investment advice or endorse any products. We are just teaching, not suggesting. So we're educators, and we are not making investment recommendations. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So with over 2 decades as a dedicated math teacher, I've changed careers from education and into real estate and mortgage loan originations, which kind of goes hand in hand because a large part of your investing is also in the financing and understanding that. So I'm both a mortgage loan originator and a real estate investor and a mortgage note investor. So I have a rental portfolio of short-term, long-term, and mid-term rentals and some mortgage notes, and I'm actively acquiring new properties, flips, I can do that, and selling on owner finance. I've been on the lending side and the acquisition side of real estate investing, and I'm liaison for Note School, so I actively contribute to the education of aspiring mortgage note investors. So I help people learn how to be mortgage note investors. And we'll have classes on that after the first of the year on how to invest in the mortgage note as opposed to the property.
And I have a portfolio of 3 furnished rentals along with my husband, and I recently left my bank job and am a full-time investor and looking for to scale the portfolio with multifamily or single family, whatever makes sense. I work with several partners, work with Brenda with NLS Investments, and then I have some other partners in Johnson City area, and we do fix and flips there. So just happy to share our knowledge about this complex topic with you guys. We have a guest speaker tonight. He's just going to kind of chime in when he has commentary, Vernon Quorum, and he is the short-term pro with over 35 years of experience, and he's my property manager for one of my furnished rentals. He does the Gatlinburg-Sevierville market. He does corporate housing. He's got his hands in a lot of things. Does software development and website development, and is a really great resource for our community.
Mm-hmm. Thank you for being here. So a quick introduction to self-directed IRAs. We're going to talk about disqualified persons, prohibited transactions, potential for taxation, how to buy a property, and how to manage a property. So we'll start out with a few slides that are just reviewing what we've taught the past couple of weeks. So if you've been here the past couple of weeks, it'll be on repeat. And we'll go kind of fast through the introduction. So what is a self-directed IRA? It is an individual retirement account. It allows for a wider range of investment options compared to conventional IRAs. Self-directed IRAs are subject to the same rules as other IRAs, including your annual contribution limits and withdrawal regulations. They can be set up as either a traditional IRA, which offers your tax-deductible contribution, or a Roth IRA, which provides tax-free distributions in retirement. So with the Roth, you pay taxes when you put it in, and then it grows and you take it out the back end and no taxes on the growth. The term self-directed signifies that although a custodian or trustee is required to administer the account holder is responsible for managing the investments and assuming all the associated risks. But with that, you also get to decide what you invest in. So that is what it is. It's self-directed, which you get to pick where your investment dollars go with the self-directed. So you could decide what are you interested in, what do you know, what do you like, what do you want to know more about, and choose that thing. So Cindy and I like to present different things that you can invest in different ways. So you could do residential real estate, which we're going to talk about today. You can invest in private businesses, precious metals, cryptocurrency, private lending, tax liens and deeds, mortgage notes, which I'll teach after January, joint ventures, lease options, leverage your properties. Yes, you can get a mortgage on a property in a self-directed IRA. Develop and undeveloped land, mobile home parks, self-storage, syndicated deals, REITs, LLC partnership or C Corp investments, and commercial property. And that's not all, but that'll get us started.
Yeah, and invest in what you know.
Mm-hmm.
If you are into crypto, you live, sleep, and breathe it, maybe you would want to put crypto in your IRA. But if you don't know anything about crypto, probably not a good idea to do that out of your IRA.
So sources of funding, where do you get the money that's in the self-directed IRA? You could roll over an old 401k plan from your previous employer. So if you had a 401k at your job, and you quit your job or you retire or whatever the situation, you can roll that 401k over into self-directed. You can have an existing IRA or HSA, a health savings account, and make them self-directed. Or you can start a new account and just start putting your annual contributions in there. And you could have a Roth or traditional IRA or both, combination. Do you want to talk about the income limits?
Yes, so you can also, I've got a little pointy thing. I forgot to ask BJ how to use it. Oh, there we go. I don't have good memory. Okay, so you can also have an HSA and a Coverdell education account that can be self-directed. And so these are based, some of these are based on your income. Like a Roth, you can put only as many contributions in there as based on your modified adjusted gross income. And Coverdell is the same way. And then $2,000 per beneficiary for Coverdell. And the beneficiary is like your children or grandchildren, and it's for education expenses. But if you have 5 grandchildren and you put $2,000 apiece, you can invest in something by pooling those together, and you can pool all of these together in an investment if you want to.
They can partner with each other, is what she's saying. So if there's small balance, you're like, what do I do with $3,000 with my Coverdell account? You can combine it with your HSA or combine it with your Roth or whatever you've got, or with your partners even.
And I'm hoping we can find a way to buy some mortgage notes with some small amounts too, which we'll talk about.
Yes, we can.
So, disqualified people. So, one of the big issues with having a self-directed IRA is that you are prohibited from having certain transactions with yourself, your spouse, your lineal descendants, your child, your children, your grandchildren, your mother, your father, and any of those people. So you can't, let's say that I bought a house in my IRA, I can't have my son do the plumbing there. He can't do any of those services. You have to be completely separate from your IRA. Which we'll get into on how to overcome that. But one of the reasons to maintain the tax deferred status is they want everything to be separate, because if they find out that you're kind of paying yourself along the way, or you're giving benefit to people that are your lineal descendants, that you can lose your tax deferred status on your IRA. So that's what we're going to be kind of focusing in on tonight, how to keep your tax deferred status. and still manage your properties. So
Other-
go ahead.
I thought it was just,
Other disqualified persons are your IRA fiduciary or whoever provides services, which that would be like if I buy a Airbnb out of my IRA and Vernon's my property manager, well then Vernon's son probably should not be doing stuff because he's going to be benefiting. So you kind of got to keep all that separate. An entity that is owned 50% or more. If I buy a rental property and I own a property management company, my property management company should not do this because that would be related. And then any officers, directors, or employees of any other disqualified entity.
prohibited transactions. You can't borrow money from your IRA. You can't sell property to your IRA. You can't buy property for personal use, even if it's occasional. So we have people that do that, I think, sometimes with the cabins in the Smokies. They'll buy them in their IRA and stay there a couple of times a year. No, not supposed to do that. Personally conduct repairs on the property or contract with businesses who own greater than 50% by IRA owner to provide services. So no personal benefit can be derived from the asset until future distributions are taken. If a prohibited transaction occurs, the IRA will lose its tax-exempt status and the entire FMV will be treated as a taxable distribution. So don't do that.
No bueno.
Yeah. Don't do that. Just leave it alone. Set it and forget it.
Yeah. So sometimes people will say that your IRA is going to be growing tax-free, that there's no taxes. And I'm very literal, and so I have to say you could be subject to tax in your IRA, depending on what type of activities you do. So one of them is the unrelated business income tax. So if you earn ordinary income, which that's a tax classification, if you earn ordinary income from an asset your IRA owns, then that would be subject to UBIT tax. So ordinary income would be like if you, let's say that you bought a restaurant with your IRA, because you can buy businesses with your IRA. But the income that is earned by that restaurant will be subject to a tax within your IRA. The ordinary income would be subject to tax. And then also, if you finance any of your investments, if you have a loan for an investment, the earnings from the finance portion are subject to unrelated debt finance income. And that tax rate is based on the trust and estate tax bill, and it can be up to 37%. So, and that's just the portion that's related to the loan. So if you bought a building, commercial building, and half of the money was a loan and half of it was from your IRA, then half of your earnings would be subject to the UDFI. So, which is not to say that you shouldn't do it, it's just, please be aware that if you have ordinary income from your IRA, it could be subject to tax. So any questions so far?
We were talking about this morning, like, would it be worth it to have a leveraged property in our IRA? I don't know, would it? What do you think? If you're paying 30% tax on the net proceeds from the property, is it worth it to put it in an IRA, or would you hold it outside the IRA? Oh, we'd have to think about it.
Yeah.
And we discussed that, like if it's throwing off a lot of cash flow, maybe it's worth it.
Yep. So I think we talked about like if it was a fix and flip. If you did a fix and flip and you had a $100,000 gain on that, but you had to pay tax maybe $30,000,
But you made 70,
but you made 70.
and it's in your IRA.
Yeah. So do you want to pay 30 to get 70? Are y'all okay with that? Because if you didn't do anything waiting for just the perfect thing, then you have nothing.
But you could also do that outside of your IRA.
You could do it outside of your IRA too.
What determines that on your unrelated, your UDFI?
Yeah.
You said it was up to 37%?
Yeah.
What determines anything lower than that?
It's the amount of income that is subject to that. Yeah. I think it was, when I looked at the schedule last, it was like, don't even quote me. It's not a huge amount that is going to take you to 37%. And the reason they do that is because, they being the IRS, is because you have a tax advantage using your IRA. And so this kind of helps level the playing field in their eyes between what you're doing and what other people are doing. You know, other people are doing the same thing outside of their IRA. They have to pay tax. So that's just something one of the rules. But if you are able to get a solo 401k, which you have to be self-employed, and there's certain other characteristics for that. But if you have a solo 401k, you don't have this UDFI tax. So that's why each investment is going to, be very specific to the investor and the situation.
Which is why you have a custodian too. Ask them. They will tell you that's prohibited or that's allowed. That's what their job is. Keep you doing it right.
I know this seems like a lot, and it is, but that's why we do the classes, to kind of like help it sink into the brain. And by the end of the class, if you have more questions, we'll definitely try to address those. So on buying the property, how do we buy the property, Brenda?
Well, the same as normal. Like, how do you normally buy a property? You just find a property and you negotiate the purchase agreement between the seller and the IRA instead of you. So it will read differently. It won't be your name. It'll be your name.
FBO.
Yeah.
FBO.
Yeah.
For benefit of.
Yes. And IRA must pay for earnest money and all pre-closing expenses. Just be careful that you leave enough money in the account to close, all the extra, leave a cushion. Leave a cushion. And the IRA can obtain financing for the property, but it must be non-recourse. So the IRA owner nor other disqualified person can guarantee it. So you might struggle to find that, but you can do that. You can leverage property in there. And the IRA custodian plays a larger role in these transactions than a checkbook IRA.
So I'm going to talk a little bit about a checkbook IRA, because, as I've been working through this, I'm learning, and I'm learning what works for me and what I like. And so my first transaction that I did was a private money loan through my IRA, and I had a different custodian, and I had to go send paperwork back and forth, and it was a big process, and I didn't like it at all. And so the way I'm going to use my account, I'm going to be moving money. I'm not just going to buy one asset right now. The plans change. They always change. But I don't plan on buying one asset and just leaving it in there and letting it ride. I plan on, loaning money, getting paid back, loaning again, getting paid back. That's what I'm planning on doing for at least part of my. And so I found that if you get a checkbook IRA, you are more nimble. You can, once you've got it all set up and everything, and it takes like 3 or 4 weeks to get everything set up, okay? So once you start, it's going to take you a month to get everything going. But once you've got it set up, you can just, if you see a property you want, you can just write a check. I mean, you still need to go through title, you still need to go through closing, the same, but you can just write a check. So the checkbook IRA does lead to quicker decision making, removes a layer of oversight, faster. You could have lower fees overall. And then the cons for the checkbook IRA is you don't have as much oversight because you're not involving your plan custodian, and you can make mistakes, and they could be not good mistakes at all. So you have to be make sure that you're in compliance with the IRS regulations, because you're not going to have the custodian making sure you're not writing your son a check for mowing the yard every week, okay? Because that's gonna kick you out right there. So, but please know that, and we can talk a little bit more about some of the custodians later, but they're there to help you. They'll answer questions, and they'll help you stay in compliance. But I think one of the things about these self-directed IRAs is, you're learning, you're studying, you're like, well, what should I do? What asset should I invest in? And so you're going to want to learn and make sure that you're, doing the things the right way. Just continue learning.
So fix and flips, the IRA purchases a property, same as you would normally, and ensures that there's a sufficient balance in the account to pay for all renovations and holding costs. And I would leave a big cushion because my experience, renovations always cost more than I ever imagined. And the IRA holder and prohibited parties cannot perform any renovation services. So if you run out of money, you can't go lay the floor yourself to save money. So you better think about that when you're doing your scope of work, and fill it out really carefully and think it through what you're going to have to pay for. Flip income, though, is subject to UBIT rates, which is up to 37% in 2023. When would this be a good strategy for you? Or would it? Or do you not like this idea at all? You got to make money with it. I mean, you can't just let it sit there. So don't you think about what you're going to do with it. You can't just let it sit there. So is this a good strategy or for you, or no?
It will be eventually. If the spread on the flip's big enough, then yeah. But having to pay that 37% taxes, they'll kick in the pants. But if I can make a good enough spread and not have to use nothing other than the IRA to fund it,
And then do it
I think
again,
it'd be a good strategy.
and then do it again,
And then do it again,
and again, and again. And if it's in your Roth, what does that mean to you?
If it's in my Roth,
Mm-hmm.
tax.
When it comes out, guess what? All that growth.
Tax-free. All the growth is tax-free.
Yeah.
Mm-hmm. This might be a good strategy, I think, too. Like if you're very hands-on and you can't let things go because you micromanage your life and everything in it, and so you're like, I absolutely am not going to touch that flip because I can't. Maybe it's a good strategy for you. Because if you're like Vernon and you're like, I'm going to go do it all myself, and I'm going to run myself in the ground, I'm not going to pay anybody to do it because they won't do it right. And so if you know that you're that person, and I mean that with love, because if that's you, maybe doing it in your IRA will keep you from going out there and laying those floors.
So you can't do anything.
Nothing.
I'm
Nothing.
saying, like, if the painters mess something up and I'm like, I can't
You
do nothing.
No. You can use your brain. You can pick the painters. You can pick the property. You can pick the colors that they're painting.
That's
No
physical.
And you can
Yeah.
have them go back out there before you pay them.
Yeah. But you know you can't provide any services.
But how are they auditing that?
You're that kid. You were that kid in school. You were that kid. She'll never know.
So if I had a fix and flip, right, and I paid somebody to do some work, and then I go back because I'm a micromanager and I want to make sure they did it right, and they're long gone, and I'm like, oh, I just picked up trash around here. Like, who's looking?
Where's guys?
I am not going to comment on that.
So we're not commenting on this.
I am not going to comment on that. That's, personally, that's why, for me, it would be like, when I do it, it's hands off. If it's a fix and flip, I find a contractor I trust, and he takes care of it. And if I go there and I see that paint is done wrong or they're gone, I go back to the contractor and say, you need to fix that.
And that's why your network is so important. Come out and network with everybody around you and figure out who you want to be working with. And when you get that nailed down, you feel so much better about any project that you're doing because you already know these people are in the community and the work that they do and their reputation. Networking is huge.
Yeah.
Invoice is key too, right? So you got the invoice for the work that you actually
Yeah.
do. So you
Never,
have to have that.
never pay without an invoice. So. I thought of something else just now that we didn't talk about today. So you have to pay, if you have 100,000 profit, you could pay up to 37,000 for UBIT. But how much does it cost if you, who has a calculator that wants to do this for me? If you have a house that you're going to buy for a fix and flip, and it's 300,000 that you have to pay for it, 3% of that is what, 9,000? And then, so what's 300,000 times 12% for 6 months plus that 3,000?
You're looking at me just because I'm not that type of age and I don't have that skills.
300,000 times 12% times 50%. Vernon, you got it? Y'all gonna make me do, I'll have to go down. 300,000 times 10% is 30,000. Divided by 2, it's 15,000. So that 300,000 times 10% is what you have to pay to service your fix and flip loan. If you got a fix and flip loan, you bought the property, 300,000. You actually have to pay 3% origination fee, maybe more.
Could be.
So 3 times 3 is 9,000 that you have to pay, and then plus interest, which was 15, we said, right? So 15 plus 9 is 24. So if you get a loan on the market for that fix and flip outside of your IRA, you're going to spend $24,000 in financing cost. And or you're going to spend $37,000 in UBIT if you do it in your IRA.
And if it's a Roth, it
So-
might work out on the back end that you get to keep more. So, would it work for you? I don't know.
So
We're
there you
not-
go.
We're just throwing it out there and you decide, right?
Giving us options.
Yeah.
Yeah. Okay. So we're going to talk about managing the property, and Brenda.
Good thing we have a property manager here. That's so convenient.
I think we
Thank
have
you, Lauren.
several,
So
actually.
nice. So, short-term rentals, Airbnbs, that's for tourism, temporary housing, and midterm rentals are corporate housing, traveling professionals, digital nomads, which is a thing now. And disqualified persons are not permitted to stay in furnished rentals owned by the IRA, so you or your family cannot stay there. But Vernon, we're going to ask you to talk about this for a little bit. I'm wondering about this a little bit. Like, how has anybody ever hired you out of their IRA to manage their property?
I don't really ever know, which is kind of good for me, sort of. But in general, I have rules that, if they're staying there, they've got to give me plenty advance notice. But, the things that I see mostly with folks is they don't do their due diligence. They don't spend enough time thinking about the whys and the hows and that sort of it in the early process. And so in the short-term rental space, if someone came to me with this idea, I would immediately go to someone like you guys, somebody that has expertise in that. I personally kind of outsource most of that, just to be honest with you guys. But on the managing side of it is, if it's up to me, I have a lot of people that come to me and they have all these questions about how they can do things or whatever. But it's good to know people like yourself in that position. So when the outsourcing happens there, I think you've got to have a test. And this is what I say. You got to trust your people, trust your process, and trust your product. So if somebody comes to me with a investment strategy, first thing I ask them is, did they seek wise counsel? You get to the person, the expert, that can teach them how to do that. The other thing is I want to make sure that they've got a good product. Because there's so many people that come to me with ideas about short-term rentals. The first thing they tell me is someone told me this thing is going to cash flow X or it's going to do this. And give me this big long pro forma that they've gotten from some corporate company that has sent it to the realtor, because the realtor's excited. oh, look, this $100,000 property is gonna do $1 million next year. Everyone in the process knows that except the guy with commission rep. So the product that we're looking for, in my opinion, is always a product that fits their investment goals. So if their investment goals are to basically break even, those are good. If it's a product like, it sounds to me like if you guys have somebody comes and says, hey, we want to buy a second vacation home, this is not the product. This is not the product for them.
They can't, yeah.
They need to think about another strategy. But for me, when it comes to, the process, I think so many people get ahead of themselves. And they just think that they're just going to throw money at something that's going to make money. And so when I'm looking at the test, have you consulted the proper people? Have you got a good process and have you got a good product? Because to me, that's the first part of it. The next thing I think is the experience. What experience are you providing? You said a while ago that there's several opportunities with short-term rentals. Some people don't know what their guest avatar is. They don't know who they're actually marketing to. So for me, when I'm looking at that, the first thing I want to know with someone when they come to me is, what is your guest experience that you're providing? For instance, she has a great property down in Sweetwater. This is such a unique, cool property that I just love it. I didn't know until I went down there and spent a little time there what the guest experience really truly was going to be. Because we had talked about it. You've got downtown Sweetwater. Right near it, it's got a lot of little shopping, little places to eat. You got a place that you can go have ice cream and cheese and sandwiches. And then you have another, you have other experiences around there, Lofty, blah, blah. Because someone might look at Sweetwater and go, vacation rental? I don't know. Currently, we have a midtermer staying there, and I just paid you today, and we both made good money on that. Those are good too. So the people that are staying there currently are in a business, and they've stayed there for several months, and we very rarely hear from them unless there's an issue, something to take care of. And so to me, what experience are you providing? And then standard operating procedures would be my S. What are your standard operating procedures? If you're going to set something like this up, you better damn well know what you're doing.
Yeah,
And I
because
guess
you can't
better
go,
know.
you can't go do anything with, you can't go wash the sheets.
And so,
Like
if somebody calls me and says, hey, I'm going to run by the property and do something, then as a manager, I would have to be able to make sure that they keep up with that. Can they pay their own taxes? Can they do that kind of stuff? Is
What's
it
that?
just physical labor?
You can't provide any services. You can write checks.
That's
So
what-
like if I bought a property that I wanted to use as a Airbnb, I could not be buying the furniture. I could not be putting that in there. That's providing services. That's a setup service.
Is there somebody, there's somebody that does that though, right?
Of course.
Of course, somebody, could you own a property, short-term rental, and not ever touch it?
Absolutely.
Is that possible?
Most people are looking for the leave in their 9 to 5. Most people are looking to buy a property that they can be truly hands-off with.
Yeah.
And so when you're looking at the things that we all do for them, staging, setup, we do all that stuff for folks. We have a full end-to-end service. And so when we're doing all that for them, they're a perfect candidate for us.
Yeah.
So if someone came to me and said, I want to do this, I want to be completely hands-off, absolutely. We'd be happy to take care of all that.
Truly passive.
Are you in trouble legally though if you don't know they're doing that?
To be honest with you,
I would say no, because it's on the IRA owner to be in compliance.
and also, a lot
So-
of times, there's certain disclosures that are made to mortgage people.
Yeah.
You have a lot of people that go in, earlier there was a conversation going on about, some tax issue things, or some tax things. Sometimes you'll get people that buy a second home. There's a lot of things that I kind of don't want to know.
Yeah.
I don't want to be the guy that, I don't want to be the referee, is I guess what I'm trying to say. So in my case, if someone comes to me and they specifically told me this, then we're going to abide by those rules. Same when someone comes to me and tells me they bought a second home, there's another process that goes along with that. And there's a lot of mortgage fraud things. My good buddy Nathan will tell you, there's a lot of people that think they're going to pull one over, and then they get in trouble because they don't play by the rules. And so I think
Yeah.
those standard operating procedures, from my perspective, if someone tells me certain things, then I'm also a realtor and a real estate agent. I'm going to hear by the codes and what it says. But
Yeah.
again, if somebody came to me and didn't tell me this and stayed at the property, I don't know if there's any liability for me or not. I'd have to speak to my attorney. But generally speaking, when most people come to me, I usually just know who the owners are, their LLC, whatever. I don't really know a lot of details. Now, I can go really deep, but sometimes folks don't want to tell you.
Yeah, I was about to say, because there's I don't know, my short experience, there's a standard onboarding based off of your SOPs. And like, unless you were to dig, like, hey, how are you, and what's all this, and all I saw was owner, LLC, whatever, cool, glad to know you.
Yeah.
I think once it's disclosed to you, then you have to do your due
Then
diligence.
you do
there.
due diligence, yep.
Yeah.
That's just, I ask as many questions as I can, but there's people that have private investors that I work with. I've got a client right now, I've never met the other investor. I'm only talking to one guy. I'm never gonna meet this guy, he's from California.
Yeah.
We'll talk on the phone, but I don't know, giving money privately somehow, and I don't, that's not a conversation I need to have.
Yeah. So this having an Airbnb and managed by a professional company could work in an IRA as long as the management company provides all the services, including setup, maintenance, cleaning, pricing, and all that.
And all the messages, right, all them back and forth. Yeah. So is this a good strategy for any of you guys? Do you like the short-term rental model? Yeah?
Could
Yeah.
your family stay in your short term? Would that be?
Well,
No
let's go back to
lineal.
that tree.
As long as it's what, a brother, sister, somebody that's not,
Yeah.
it can't be a son or daughter.
Like,
or
if
somebody.
the rent, like,
Your in-laws can.
like
Yeah.
my mom and dad, they could not.
No.
stay in the
Cousins, your
short-term
uncles, and
rental.
stuff. That's good to know. See, guys, I didn't know that. That's good information.
Yeah.
I didn't have a clue about that.
That'd be a family quarrel, though.
Yeah.
Yeah.
I personally just wouldn't tell them about it. They don't need to know.
Well, the benefit to the other people though is down the
Need
road.
to know basis.
It's not using your nice property right now.
Yeah. You're building wealth.
You're building well.
Yeah.
So they're gonna get the benefit down the road.
Yeah.
So that's how I would explain it.
And then if you want to rent a nice place, rent you a nice place, just not your place.
Well, I found too, a lot of people that have a vacation rental, they normally wanna rent it during the most popular times.
Yeah.
It costs me money, it costs them money. And I always tell them when they come to me at the end of the year and they say, hey, we're down 20% this year. Well, remember when you were there from, July 15th through July 30th,
Yeah.
some of the best times we could have made money.
Mhm.
That's probably the reason. But that's my first strategy was I always tell people use it in the off season as
Yeah.
much as possible.
Well, and then also, if you find a property that you want to buy, and it makes sense for it to be an Airbnb, and Vernon manages it for you for a couple of years, you ride the property appreciation wave, and then you sell it, and that gain is going to be, it's not going to be UBIT then. It's going to just be a regular gain, that it's not going to be a tax event for you. Okay, so let's talk about unfurnished rentals, apartments, duplexes, single-family homes. A lot the same on this. We have several property managers in the room.
We're just
So-
talking about some of the long-term tenant dramas.
So if I bought a multifamily, I've looked at 2 in the last week that I'm considering. And I have money that I'm rolling over from my bank job that I would have enough. But one of them I know I got to get my hands on, and I got to get in there and I got to do the stuff, So I'm like, that one I can't put in my IRA, but the other one, it's a triplex. So one unit needs to be renovated. So if I were to get that, I'd have my GC renovate that unit, give it to my property manager, and say, go on. And she would place the tenants, she would collect the rent, she would do the mowing, make sure the mowing. Billy can't do the mowing on that, even though the yard's small, and even though the IRS guy's not walking around the corner checking. I mean, I try to err on the side of caution, and so Billy, one less yard for him to mow.
So would it be wise to say then that you basically, the only time you might want to go visit the property is just when you want to go put eyes on it? Or do you just trust the,
No, you can put your eyes on it. I mean, you're still
if
managing.
you're walking through the yard and there's a piece of trash there,
Yeah.
Just leave it.
I guess that's where it gets a little tricky.
Yeah,
Call the property manager and say, hey, send somebody out.
yeah.
So I'm just saying, there's semantics here that I.
Yeah, there is. And I mean, there's been enough, what am I trying to say? In the tax law, they have suits in the past, whether, does this count as enough to terminate the tax deferred status or not? So they've had court cases on that. And, they go one way, they go the other. And so I'm just like abstaining. I'm just like, we're just not going to mow. If we go there, yeah, I'm probably going to bend down and pick up a piece of trash. And I have to manage my investment. It's in my IRA, so I still have to manage it. I have to go, if I drive by and see they're not mowing, I call my property manager and tell them. But other than that, I'm passive. And it's like that for out-of-state investors, that have properties in Knoxville and they live in California. Somebody's managing their property. Same thing.
I'm catching the theme. You like
Denise?
people to hands off.
Or who was that?
No, I said they're my favorite.
Oh,
Yeah.
Two of my best investors live in California. Never seen them.
yeah.
They just trust me.
Yeah.
Yeah.
And that's how you build your network with who you know, like, and trust. And
Again, the network.
yeah.
So is this a good strategy, the long term? You like that better than short term? Yes, no?
I'm a fan of that one.
Why? Why Darius?
I just feel like you can ride that wave. And in my experience, this is the hands-off thing. It's not as quick turn. You don't, I don't know, you're not, I worry less if I know like, hey, that was done one time and close my eyes and let them handle it. And then I just be the out-of-town investor. Like, whatever is my check showing up. Like, call me with an emergency and tell me I can buy a new, water heater, whatever.
So in the long term, I have both, short term and long term. So I can see the benefit of owning short term and owning long term. I think in the long term, I'm not stating that I would do one or the other because I'm not trying to sway you in any way, but I think the long term, you definitely don't touch it as much. Like, there's not as much going on. The short term, it's a constant, everything's going on all the time. Things you would never dream happen in the short term, and you've got to take care of it. Somebody has to take care of it. Long term, it's less is happening. It's just sort of kind of boring, and that's good. You don't want to hear from the tenant. You want to sign a lease, don't talk to me for 12 months. That's what Richard Gamble always says. He's like, I don't want to talk to you for 12 months. Just silent, and then you're done. So I don't know, which one do you like better?
It's like a faster growing IRA.
Why is that?
I mean, depending on the IRA, how it was set up, and you have income limitations on what you can put in annually, correct? Like,
Yeah.
that doesn't dictate what your rent is for that market, and that rent can go up every year. The IRA is, it's affected by other things and money, right? But
Yeah, you've got appreciation is happening, year over year. You're putting your net income in there every month. Everything's staying in there.
It's snowball. It's like a snowball
Yeah,
effect.
so it keeps going
grows
up.
over time with your contributions as well.
Yes, Vernon?
One of the differences I see in the two, I have people come to me all the time wanting to know which they should do. Should I do long-term or should I do short-term? What I like about long-term is there's consistency and it's just standard growth. And it just kind of keeps people, it's a nice little paycheck every month. Where short-term rentals is more volatile. There's a lot of things that can affect it, the elections, inflation,
Yeah.
travel, so many different things. And like you said, there's a lot of moving parts. So the person that comes to me and says, hey, I just want to make, a little bit of money. I just want steady income. I don't want to lose it. Well, let's go this route. Somebody wants to come, they want to have a little bit more risk, a little more exposure, and truly be okay with somebody using their property 24/7, just in and out, in and out, in and out, with
And
a lot of churn.
the draw is that it's more cash flow,
But you got
in
more
theory.
cash flow. Exactly.
In theory.
In theory. That's if the market plays right. COVID numbers are incredible. They were incredible. I mean, I
Yeah.
had 90-some% occupancy, plus we had to close properties to do maintenance and do things on them. Now, 56, 60% is a decent occupancy in our market. You get up to, you get a little bit more, but most of the time when people come to me, I always ask them what their goal is. If it's just to make consistent money, just go with the long term. It's so much more safe.
Yeah.
And I'm a short-term guy, so if you got a little time, a little bit of ability to do a little risk, maybe take a chance, whatever, and hope for the bigger payout, then
Yep.
short-term is definitely a good option.
You could try it too, and then if you don't like it, you can switch it back to long term. But don't I can't say don't do this or don't do that. I just want you to consider, if you pay the price of this property based on the numbers of a short-term rental of what was told to you on, what's that performance report called? And you going off of that number, which is probably not accurate, and then you pay that price for the property based on that, and then you switch it to long-term,
That's going to hurt.
it's not going to match up.
Yeah.
Sure, it's never, and I've walked your properties, all of yours, and I can tell you that yours would be either one. The location's perfect for either one.
That's why I bought those houses.
Exactly.
I don't buy those cabins, and I'm not telling you what to do. You can do what you like. But if you look per square foot, I know if the city came in and said you can no longer do short-term rentals, if I had paid twice the amount per square foot, and now I've got a long-term tenant in there, I just lost myself. And that's too much risk for me. But there are people that do it all the time,
Yeah.
and it's fine for them. So what do you like?
2 other points that I'd like to bring up. One, if you're doing this, any building in your IRA, you lose the benefit of depreciation, because
True.
depreciation is shielding your income from tax. Well, it's already shielded from tax because it's in there. And then, oh man, there was something else.
Do you understand depreciation of property and what it does for your taxes?
So, here's the other one.
So you're not doing a cost seg on this one, is what you're saying?
No,
None at all?
you wouldn't need to. The other thing is, this is part of your overall portfolio, because you're going to have some of it in stocks. You're going to have some of it in real estate. You're going to have some of it in this, that, and everything else. So, as part of an overall diversification strategy, if 25% of it is in a multifamily that is just chugging along, in 10 years, when you wake up and the market crashes, you know that your multifamily is still going to be okay, So,
Maybe not as exciting to watch, but still there.
okay, pop quiz. All right, so your IRA is purchasing the land and a building for the purpose of operating a pizza restaurant. Can your son work as the manager of the restaurant and be paid a salary? No, because he is a disqualified person. That is a prohibited transaction. So you own a construction company. Can you go renovate the building and provide ongoing maintenance services? Nope. This is too easy. We're two good teachers. Y'all know all the answers.
They're too good students.
Will the profits made from the sale of pizza be subject to unrelated business income tax? Yes, because it's ordinary income. So let's reframe this a bit. If your IRA owns the land and the building and you lease it to an unrelated third party, and that third party owns and operates a pizzeria, are you subject to UBIT? No. Because you're not doing ordinary income activity, you're doing the passive real estate lease. Good job. We got cookies in there. Okay, oh boy, we are already at that slide. Brenda, let's skip to the custodian and talk about custodians a little bit.
Okay.
Go.
So this is a list of some well-known custodians that you could pick from. Inspira, that used to be Quest. Anybody use Quest? Who has a self-directed IRA in here already? Here we go, the star, our favorite student. So Inspira used to be Quest. It has a lot of educational content. If you're like one of those people that likes to absorb educational content on YouTube, look up Quest and start watching some of their educational content. And they offer a wide range of investment options, including private entities and promissory notes. And they're great. They really understand mortgage note investing, so they're good for that. Equity Trust Company is a wide range of alternative investments. It's got a great online account management tools. One of my private lenders uses that, and I pay through that. It works pretty well. And then Madison Trust offers a variety of investment options like real estate, private placements, and precious metals. and provides extensive educational resources and offers that Checkbook IRA and many more. Would you get a Checkbook IRA, yes or no?
If I was really experienced, then maybe.
I don't trust myself. Cindy is way better than me. She probably is fine with it, but
I am chomping at the bit to get that.
but I would be afraid I would be like impulsive or something and mess up. So
Well, and the thing is, all of these companies, and there's more, they are very helpful to you. You can call and set up meetings with them to ask them questions. You know, if you have a checkbook IRA and you want to give a private money loan to, you know, your brother-in-law, you might want to check and see if it's okay, even though you think it probably is because he's not a disqualified person. But I mean, you can call them and talk to them, and they will give you counsel on that. And there's lots of trainings, webinars, YouTubes, and I recommend if you start watching a series of educational programs that you don't skip from, you know, John does this and Terry does this kind and so, and you know, you have like 25 different people teaching the same content. Don't listen to 25 people. Try to just narrow it down. Listen to a few. And, well, that goes for real estate investing, too, because everybody has a different strategy. But there's so much education out there to help you know and help you make sure you're doing it right. So who is ready to open IRA? I mean, I'm not selling anything, so who's ready to get there started? Arlen.
what have you done with it since last time we
I
talked?
have reached out to someone about a PML, so we're doing details of what I want to do.
Of what?
Like a private money loan.
You're going to do a loan?
Yeah.
Nice. What are you loaning on? What's the collateral?
Well, she has a couple of things, so we just started talking like, what's today? Tuesday? Yeah. So Saturday, so I have the stuff, so I'm looking over stuff.
Real estate? Is it secured by real estate?
Yeah, that's all. I don't know or anything like that, or.
Yeah.
Yeah, we'll talk about that private money lending at the end of November.
Yeah. Feel like
That'd
2
be
weeks.
good.
Yeah.
Yeah, we're going to talk about that.
Something,
Yeah. And we'll go to some training in January, too. We'll come back with education to share. So we're going to talk about private money lending on the 26th. So, and you can hire a transaction coordinator to help you with that, too.
Okay,
You
I
don't
actually
to,
have one. I can give you her number.
that'd be great.
You don't have to suffer in silence.
Yeah.
So we'll help you with that. Just give us a call or set up a Zoom or something. And then in January we're going to start note investing, mortgage note investing. Did you know you could do that? That you can be the bank and own a note.
Give us a 2-minute sample of what note investing is.
Well,
You notice I had to limit her on that.
well, it's a big education, and I've been studying for many years. I've paid a lot of money for it as well. But the idea of it is you are the bank, so you fund the purchase of the property and you hold the paper, not the property. So it's deeded over to the person that bought the property, and you just have the loan. They took the loan out with your money, and so you're holding the note, and they're making you payments. And it really is passive. Like, it's truly passive. Like, do you call Truist Bank when your HVAC goes out?
No.
No. So you really do just get a check. And if you're big into spreadsheets and them putting them numbers down, and you like the numbers to really be what the numbers are, note investing is that. And it's just not talked about a lot, I think, because it's not super sexy, like fix and flip or short-term rental, Vernon Quorum.
I just had a mental image with fix and flip with a little skirt on.
You know, it's not like that. It's just boring to some people, but it's very steady. It's very steady, and you can get some very decent returns. And mortgage notes and self-directed IRAs go very well together.
So I have a strategy that I'm working on with some my partners in East Tennessee, more east than here. What we'd like to do is find some land and put either tiny homes on it or trailers, mobile homes, and then carve out each parcel and sell them to a homeowner. And we can sell them, we can have Brenda write the notes, because Brenda does lending. We can lend, we can find our private money lenders. We can call Arlen and say, Arlen, we got this guy with a mobile home. Do you want to write a note for him? And, or we can just finance it ourselves. And then, so here we go. I'm going to explain. It's a little complicated. So let's say that if I spent $100,000 to develop the parcel and maybe another $50,000 to put the tiny home on it, for easy math. So I have $150,000 in it. I sell it to somebody for $250,000, and then I am going to write the note for them. How much is a note over 30 years for $250,000? What's the total amount? It's going to be like $450,000, right?
Yeah,
The total
it's gonna be a
payments.
large amount. What are you gonna charge them for an interest rate?
I don't know that. I'll let you figure that out.
Okay.
But so we sell it to them for, where were we? We were at $250,000.
You sold that, you really upcharged that property.
I
You
did.
sold it for $250,000.
Easy math. Sorry.
Okay, that's good. That's good investment.
$250,000. They bought this house, this nice parcel of land, and so we have a mortgage, and we're going to sell that mortgage to Brenda. Have Brenda sell it for us.
You can buy the note. You can sell a note, just like any asset. You can sell a note.
And we could sell that mortgage for like $450
It depends.
or something.
Notes are bought at a discount. That's
So-
another conversation. But
So we can have $150,000 in that parcel, and we can sell it. We can get our cash back. We can make,
you can make good money.
A
You
lot.
can make good money in mortgage note investing.
and
We'll talk about it.
and it's not just about us making money. I mean, these people have a nice place that they're living in,
Mhm.
and it may be under market for other homes in the same area. $250,000. That's
It's
not a bad
affordable
price.
housing for people that couldn't get financing.
Yeah,
So you bought the plot of land,
not yet.
you divide it into parcels.
Yeah,
Amazon drops these small homes. for
That's right.
$30K a pop. You ran plumbing through your friend
yeah,
because it's not an IRA.
yeah. Not an IRA.
Yeah.
Yeah,
Yeah, and then you sell it on a note. then you write a promissory note.
Yeah. I just kind of went off on a tangent
that's
that way.
passive.
But that's what I'd like to do, and kind of help people get some good quality affordable housing, and keep everybody working.
Big
So.
banks do that all the time, don't they?
The banks are
Sell
pretty.
notes all the time.
Yes, they sell their notes. Yes, there's a whole market to sell notes on the secondary market. Yes.
Like a random question. There was someone that tried to teach me this before, and he was drawing on a whiteboard and said someone could own a note, and then there's another person that buys it, but then it kind of like makes babies, and this person that bought it can sell it again in like 2 different pieces. Is that real? Like they can just keep on selling notes and to the next person?
You're not supposed to sell. Like you can't be setting up like a fund. There's a whole lot of rules to do that. You can do that, but I'm not ever going to do anything like that because you have to go through there's a lot to that. But if I had a note that I bought, and I have a note that I own, and I said to Cindy, I can offer this as collateral. Will you loan me money and this is the collateral? Then yes, that's called pledging a note or hypothecation, and you can sell. Or you can pledge it. I still own the note, but it's the collateral that she loaned against. So you can do that. Or you can sell a partial, which is the front piece of the note. This is a whole conversation. We'll have a class on this. But there's all kinds of different things you can do
Yeah.
with mortgage note investing. Yeah.
So we're just, trying to introduce these next level concepts to everybody, so, we can start thinking big and building our portfolios and building our wealth.
Yeah. And I like the idea of us all working together instead of sending our money and our business out to we don't know where, in the cloud or something. Or, when you're investing with Self-Directed IRA, you can invest here in your community with the people that you know, love, and trust, and provide jobs and housing or whatever you're doing in your own communities, and you can see it. You see the difference that you're making.
Thriving and happy community.
Mm-hmm. Any questions?
Could that be done as like a 501c3?
The
Like setting up the little give back thing you're talking about, like helping, is that something that you can actually?
I haven't looked into that, honestly. I don't know.
That might be We could add this to our education, somebody
It'd
could
be a
come.
nice little community thing that everybody can be a part of.
I would love it because one of my partners, his name is Landon, and he always gets these mobile homes cheap, and you can fix them up. And that's another thing about, attending all these network events. People are buying and selling mobile homes like nobody's business. And you can fix them up.
They can be
And
nice.
then they're nice. And you would think that sometimes you look at these mobile homes and you're like, well, they don't look very nice, but they're renting for what, $1,000 a month? You paid $50,000 for it. How long does it take you to make back your money? Doesn't take very long.
And you provide affordable housing.
Yeah, and you can do that in your IRA too. You can
Yep.
buy a bunch of mobile homes.
So if you had
and-
a little bit of money, not a lot of money, you could do that.
And sometimes it's like, you've got the money sitting here, like it's in my IRA, it's not in my, Regions bank account. What do I do? What do I do with it?
You do something with it, is
Yeah.
what you do with it. You don't let it just sit there, because then it devalues itself every day. So keep it moving. Velocity of money, velocity of your IRA. Any questions?
Mind blown?
Something to think about? So what's something you're going to go think about or research? What's on your mind from this discussion?
Mine is like the difference between infinite banking and then using like this, because I guess it's like the same concept but translated in many different ways.
You could call this being your own bank.
Yes,
Being
because
your
that's
own.
what they say also with infinite banking.
Yeah,
is
being your own bank. I have some training coming in for that too, by the way. I'll tag you in that. What about you, Vernon?
I like the private money lending aspect of it, because I don't necessarily want to get into a lot of the other, I do it for a living, so for me, I would rather give someone else the money, get my return on it, and just continue to do that.
You should do that.
As I start thinking through this process, that would
And you know the investors you would trust with your money and the
Sure.
ones that you wouldn't,
absolutely,
because you're in the networks,
absolutely.
because you're out there and all the things, meeting all the
So
people.
that would be my takeaway from that.
What about you?
I follow up with Vernon there. I like the thought of lending from that IRA.
Okay.
It's like a really totally passive way to generate good gains.
Would you do your loans short-term or long-term? Like 6 to 9 months or 2 to 3 years?
Probably in the beginning, short term.
And then, y'all can't really talk about it, but I mean, you do a little better interest on that, right? I mean, honestly, it's a fix and flip. I know people that are loaning money at some pretty ridiculous.
Yeah,
Well,
And it's
it's-
usually because they don't care because they're flipping the.
Yeah, the interest rates can be all over the place.
Well, here's the thing though, you can experience drag though, if your money is coming in and coming out. How fast are you sending it back out? Because those months that it's sitting there drags the yield that you had on that, because you could be saying, oh, I got a really big yield on that loan, but then it sat stagnant for 6 months because you didn't have anybody else to loan it to. Versus that one person that you know's got a 5-year deal and you send it down the road for 5 years at a steady return, you're going to get a better investment in the long run. Does that make sense? So it's just something to think about.
And there are usury laws to be in compliance with. I have to say that. This is for being recorded.
Yeah, consult
Limit.
an attorney.
Limit on how much you can charge interest in the state of Tennessee. But a good transaction coordinator will help make sure that you have that taken care of.
What about you, Darius?
I'm still a little bit like cloudy on it.
That's okay.
I know we only talked about short-term, long-term, mid-term kind of investment, stuff like that, but I'd be interested in like the commercial space with the IRA, or like you said, buying the building and the land, that the pizza place open.
You like commercial property.
I don't know yet, but I'm interested because I feel like I bought the piece of land that Chick-fil-A landed on because it was cheap in Hardin Valley, and now I know it's never going
Bingo.
anywhere. And bingo, I made it, right?
Yeah.
You hit it.
Yeah, so, I don't know, just, it's interesting. I'm gonna do a lot more research and just.
Yeah, something to think about. What about you, Ivy?
Still on the private money lending, but what you just said about the lending out for longer. 'Cause about too. I was just thinking short-term and turnover.
Mhm.
And then, yeah, Chick-fil-A land, I would.
Give me some of that Chick-fil-A land.
I have Chick-fil-A. I don't have like, having my way Burger King.
That's why I don't sell my
Yeah,
Boys Creek
something.
property, Vernon.
Something commercial.
That Boys
right?
Creek property, that's why I don't sell it.
Dutch Bros just came in here and blitzed everybody.
Everybody.
Yeah.
And
Hey,
then
that was
finished.
dead end barbecue, and then it went away, and now it's Dutch Bros. What?
Well, here's the thought that just landed. If you had a checkbook IRA already set up and you're like, I'm just waiting, you find a piece of land, you just buy it. You just hold it, see what happens. You know, you could sell it again 6 months later, whatever.
Or let it sit there and appreciate and make money on the sale. Tax-free money on the sale. Plus, how busy do you want to be with it? How many times do you want to deal with it? How many times do you want to do the transaction and loaning the money out? You know, I mean, just up to you.
I mean, to me, buying a piece of property sitting on it.
Okay.
Yeah,
It's
you could.
easy. I mean,
Okay.
Yeah.
and just paying off the appreciation.
This is not investment advice, but there's a water trail going in West Knoxville. And I already know people that are buying up stuff because they're gonna put barbecue stands and little canoe places and all kinds of stuff. And
Oh, cool.
so there's opportunities even in our own little city here to be in a place where there's gonna be a lot of high traffic.
Opportunity is all around us and everywhere.
Fast growing area.
It's everywhere.
BJ, you got any new thoughts?
I'm originally more for the short term, but I think I'm actually looking more long term. But again, just figuring out how I want to go about it.
Joey?
I'm still gotta figure out how to get my 401k to a IRA.
You still work at the same job?
Yep.
A lot of times when you're at a job that you can't move it, it just depends on the rules of the plan at your job.
Yeah.
BJ's recruiting. Come work here.
Or both you can transfer.
That would actually work.
Or you can start
You could start your own,
doing Roth contributions or
Mhm.
something and start building it.
I have both.
or you
I
can do
have
both.
one from employee now, I have a Roth, so
Mhm.
absolutely do the Roth on the side.
Oh, yeah. And once you put into the Roth, you can take out without any fees or penalties in the event you have an emergency and you need to.
Billy, any thoughts?
What's your favorite way to invest so far?
Favorite ways to invest, I like long-term, because we've dealt with this short term, and, we've got, well, it's not really long-term, it's like mid-term, but for me, it's long. Because you ain't gotta go there every week and do the turnovers and get everything set up and spending time and
It's a
money
lot.
and effort and everything, and the long-term people, you just leave them alone and they just do their thing.
And on that short term, it's so exciting to start. You're like, oh, I got a new property. It's so pretty. And then after a year, 2, 3, 4, it really wears on. It starts to wear on you.
One thing we
Don't you
didn't talk
think?
about either is usually traditional long-term management is cheaper.
Yes,
Commissions.
of course.
The short-term rental is a lot more expensive.
Mhm.
And there's a lot more transaction fees on that side too. Because everybody's gotta get paid.
Mm-hmm.
The OTA's gotta get paid, the booking, Airbnb's gotta be paid.
Your pricing manager's got to
Yeah, your
pay for
revenue
that.
guy, the manager,
Everything.
there's a lot of expense, and a lot of people tell me, oh, I'm getting 80-20 split. That is not a true statement. Short-term rental, unless you're doing a true 20-80 split with somebody, management companies are not making any money if they're doing a true 80-20 split. They're just not. They're not making money. So when you're looking at it from a standpoint of Verbo, if you're the merchant of record, that becomes another thing. So I recommend to people a lot of times to start with long-term. It's a lot easier to understand. It's just simple.
Mhm.
And then if you really want to go deep and you want to get, I'm looking for a lifestyle asset. That's what I'm looking for. I'm glad I didn't invest where we were thinking about it. Down in Florida, Indian Rocks Beach just got nailed.
Oh,
My wife and I look for properties down there.
yeah, I've
I
talked
would
to
love to be down there.
Yeah.
But again, there's the other side of the short-term rental as well.
I say invest what you know, where you are, and just travel and pay to stay where you want to stay.
Right.
Yeah, there's a lot to consider on the short-term, long-term rentals, but it is exhausting after a while. It can be.
Well, that
But
is.
there's a plus to it too. If you have to sell your properties, and you need a fire sale, this is what I like. Your properties are ready to sell. You could call your favorite realtor, say, list my properties. You could sell 5 properties in 30 days.
Yep.
If you have tenants in there, not so much. You know,
It's truly turnkey in a lot of aspects.
you could sell them.
Because those guests can transfer to the next buyer.
And the maintenance and repairs and the upkeep is done consistently on your short-term rentals, and your long-term rental maybe not. If your tenant's really hard on the property and they've been in there for 10 years, and you have to go in there and clean it out because nobody paid any attention to what they were doing for 10 years, then you got a problem. Where if your short-term rental, you know, you can sell them pretty quick, and they're staged.
Yep.
So that's a plus. BJ's looking at his watch. We already
Okay.
No, sorry to finish.
No, that's it. And, you know, we're available if y'all have questions or anything. And thanks for coming.
Yeah, thank you. Thank y'all.